So for this session, we will talk about the third part of the general principles of taxation, that is the different kinds of taxes, and of course, the definition of a tax. So what are the different classifications of taxes? So let's start first with as to the kind and authority and or as to the taxing authority. So whenever we say as to taxing authority, this is the authority to impose tax. This is the authority to impose tax. So generally, we talk about your national government and local government. National government and your local government. Your national government, of course, imposes national taxes, while your local government imposes local taxes. We have learned before that taxes is generally legislative in nature. So when we say legislative in nature, it means that only the legislature can pass tax laws. And who can pass tax laws? At national level, we call that your national government, but in local level, we call that your local government. So if ever it is imposed by the national government, we call it national taxes. But if ever it is imposed by the local government, we call it your local taxes. So as a rule, the different taxes under NIRC are your national taxes. So value-added tax, estate tax, donors tax, documentary stamp tax, income tax, uh, other percentage tax. Those are different taxes under the national government. How about in your local tax? The main local taxes are your real property tax. We also have business taxes, and then we have your community tax. So it is easier to understand or to memorize your taxes according to taxing authority by determining the different types of local tax, because you only have three types of local tax: real property, community, and business tax. All other else, national government tax. By the way, although there is a business tax under national government, we don't call it business tax. We call it either VAT or percentage tax. Therefore, if ever the question is which of the following is not considered as a uh, national tax, if ever one of the choices is business tax, that should be the answer. Why? Because we don't have the so-called business tax under NIRC. We call it VAT or percentage tax, but the business tax is under local government tax. So under local taxes, RPT, business tax, and community taxes. All other taxes are considered national taxes. So any taxes provided by your NIRC is considered national tax. And those provided by the local government code are called local taxes. Next classification as to purpose. The first one is fiscal. So whenever we talk about fiscal, again, that is for revenue purposes. So we have learned before that taxes is used to raise revenue to defer our government expenses or government needs. So anything that for the purpose is to raise revenue, we call it a fiscal tax. Most common example of fiscal tax is, again, income tax, transfer taxes such as your donors, and your estate tax. Next, we have your regulatory tax. So what do we mean by regulatory tax? Again, one purpose of taxation is for regulation. So when we say for regulation, we use tax in the exercise of police power. So if ever the tax is more on regulatory in nature, we call that the purpose of tax is regulatory. Most common example here is excise tax. Next, we have your special or sumptuary tax. For your special or sumptuary tax, these are imposed for special purpose, normally to meet social and economic needs. Special purpose to meet um, national, social, economic needs. The most common example here for special or sumptuary tax is your special education fund. Do you still remember if you charge RPT, there is a special education fund tax? Special education fund. Okay, the special education fund tax is considered a special tax that is for the special purpose, the special education or for education. So generally, so when we see taxes according to purpose, you just again list down the different purposes of taxation, that is fiscal, regulatory, special, or sumptuary. So for fiscal again, if the tax is raised for revenue purposes, that is to defer the government funds or needs, then it is called fiscal tax. Most common example are your transfer tax, revenue tax, or income tax. So those are fiscal taxes. Now for regulatory, again, we use police power, or taxation is used as an implement of police power. In short, we use taxation for regulation. One common example is excise tax to tax the seen products. Next, we have your special or sumptuary for special purpose to meet national, social, or economic needs. Now let's proceed to as to subject matter. So one classification of tax as to subject matter is your personal poll or capitation. So when we say personal poll or capitation, this is generally a tax imposed on an individual. Tax imposed on individual. So the most common example here, of course, is your community tax certificate. By the way, your community tax certificate is known as cedula. I hope hindi kayo nalilito. Pag sinabing RPT, yan yung sinasabi ninyong amilyar. Pag community tax certificate or CTC, yun yung tinatawag nating cedula. So, most common example of personal tax is your CTC or cedula. But remember, we have discussed before under your constitutional limitation that no person shall be imprisoned for non-payment of debt or poll tax. Therefore, if you do not pay your cedula or your community tax certificate, you cannot be imprisoned. That is pursuant to our constitutional limitation. Next, we have your property tax. A property tax, of course, if the subject matter under personal tax is persons, for property tax, what is the subject matter? Of course, the property. So when we say property, it is imposed on whether it is a real property or a personal property. It could be based on its value and based on some method of apportionment. So the most common example of a property tax is, of course, real property tax, which is also known as your amilyar. Next, if the subject matter is a commodity or excisable articles, then we call it excise tax. If the, again, subject matter is commodity or excisable articles, then we call it an excise tax. So these are your different sin products: alcohol, cigarettes, perfumes, automobiles, jewelries, other non-essential goods, sweetened beverages. Those are types of excise tax. Next, we have your privilege tax. When we say privilege tax, the subject matter here or the object is the privilege, that is the performance of an act, enjoyment of a privilege, or engaging in an occupation. Again, when we say privilege tax, the tax is imposed on the performance of an act, the performance of a privilege, or the exercise of an occupation. So these are common examples of privilege tax. So the most common example is a tax on your professionals or professional tax. So that is considered as a privilege tax. So when we say as the taxing authority, again, who imposes the tax? For as to purpose, the purpose of tax. It could be fiscal, regulatory, special, or sumptuary. As the subject matter, or we call this one object of taxation, then it could be person, property, or privilege. Privilege can be excise or privilege tax. Next, as to incidence. So when we say incidence, who complies on the payment of tax? Or in short, this has the burden of paying the tax. Oh. So who has the burden of paying the tax? It could be direct or indirect. So when we say direct, the person who has the impact of taxation. So we already learned about impact, right? When we say impact, the one being imposed, okay? The one being imposed. So when we say direct, the impact of taxation and the incidence of taxation is the same. So when we say the impact, the one who has been imposed also has the burden or the compliance to pay the tax. So most common example is income tax. The one who earns the income is the one who pays the tax. At the same time, donor's tax, the one who donates is the one who will pay the tax. So if ever you have the impact at the same time, you're the one who's paying, then we call that direct. So indirect, the impact and incidence falls under one taxpayer. Impact and incidence falls under one taxpayer. How about an indirect? Under indirect tax, here the impact and incidence does not fall on the same taxpayer. So if indirect, it falls to the same taxpayer, and indirect, it does not fall to the same taxpayer. Most common example, value-added tax. Why? Who has the impact of taxation? Who is imposed of tax? Normally, the businesses. However, who pays the tax or who has the burden of paying the tax? It is the consumer. It is the consumer. Since there are two different types of taxpayers, who has the impact and incidence, we call it indirect. But if ever the impact and incidence falls on the same taxpayer, we call it direct. Okay? So direct, same impact and incidence. Indirect, different impact and incidence. That is as to incidence. When we say again incidence, that is the person who has the burden to pay the tax or who should comply in paying the tax. When we say impact, that is the person who was imposed of the tax. So again, in our example, indirect tax, who was imposed? It is the business. Indirect tax, who was imposed? The business. However, who actually paid it? The consumer. We call that indirect tax. But for direct tax, let's say income taxation, who is subject to tax? The person who pays it, the same taxpayer pays for that particular tax. We call that direct. And indirect, that is as to incidents. Now, as to other classifications of taxes, we have as to amount. When we say amount, it could be a specific or ad valorem. So when we say a specific, it is a fixed amount. Okay? A specific, it's a fixed amount. Ad valorem, it is a proportion of the amount. Proportion of the amount. So normally fixed amount based on a unit of measure. So for example, 3 pesos tax per kilogram. So if ever the unit of measure is kilogram, you have a fixed amount of tax of 3 pesos. But for ad valorem, it is a proportion of the amount. So one common example here is the 8% tax. So 8% of the gross income is subject to tax. Okay? So that is the amount of your tax. We call that ad valorem, a proportion of the amount. Another example is your CGT, 6% of the selling price or the fair market value, whichever is higher. That is considered ad valorem. How about a mixed tax? So when we say mixed tax, it could be specific plus ad valorem. Is specific plus ad valorem. So there are items also of your excise taxes or your excisable goods that is subject to mix. There is a specific, at the same time, there is an ad valorem. Now, as to rate. So the first item of your rate is proportional. So when we say proportional, we mean a flat rate. So for example, 8% tax, 6% tax, that is considered proportional. Another is your VAT, 12% tax, that is proportional. Percentage, so proportional. Corporate income tax of 25% or 20%, again, that is proportional. What else? Sale of shares of stock, 15%, that is considered proportional. So if ever there is a flat rate or it is based on a fixed percentage, we call it as a proportional tax. Now let's go to a progressive tax. A progressive tax is a graduated tax rate. A progressive tax is a graduated tax rate. So what is this graduated tax rate? The tax rate increases as tax base increases. So tax base increase, therefore tax rate will also increase. How about in a regressive tax? In regressive tax, the tax rate decrease as the tax base decrease. So in short, if the tax base will decrease, the tax rate will also decrease. So again, if you still remember, the Philippines should adopt a progressive system of taxation. That's why all of our taxes are progressive. There is no regressive tax. So in the Philippines, no regressive tax. Why is that so? Because again, there is a constitutional mandate that the Philippines shall adopt a progressive system of taxation. How about a mixed tax? When we say mixed tax, that is a mix of proportional plus progressive. It is a mix of proportional and progressive. So, uh, most common example is your income tax. Why? There are items of income that is subject to proportional, but also there are also items subject to progressive. So let's say we have CGT, that is an income tax, right? It is subject to proportional. However, some other items of sale, let's say an ordinary asset, it will be subject to progressive. So that is considered a mixed tax. So a mixture of proportional and progressive is known as a mixed tax. Now, those are again the different classifications of taxes. So let's review the different classifications of taxes. First, as to the imposing or taxing authority, we have national and local tax. So when we say imposing authority, whoever imposes the tax. Next, as the purpose, again, this follows the purpose of taxation. It could be fiscal, regulatory, or sumptuary or special. Then we also have your subject matter. So when we say subject matter, the object of taxation, it could be person, the property, or privilege. And when we say privilege, we can also say excise tax. So excise tax only to excisable or commodities subject to excise tax. Furthermore, as to incidents, who has the burden of paying the tax, it could be direct and indirect. As to amount, we have a specific, ad valorem, and mixed. As to rate, we have proportional, progressive, regressive, and mixed. And we said there is no regressive system of taxation or regressive tax here in the Philippines because of the constitutional mandate that the Philippines only adopts a progressive system of taxation. So those are the different classifications of taxes and dependent on their types or classifications. Now let's go to your distinction of tax with some similar items. Let's start first with your tax versus revenue. So although we say tax is one of the source or main source of the government, so the main purpose is revenue raising. However, what's the difference between a tax and a revenue? So when we say tax, it is the amount imposed. It is the amount imposed. However, for revenue, it is the amount collected. So for example, we have here a tax. When we say you are subject to 6% tax, the 6% is the imposition. So once you collect now the 6% tax, we call it now your revenue. Next, as to the scope, for tax, it is one of the sources of government revenues. Well, again, revenue is the product of taxation. It is the funds derived from tax or from other sources. So normally, tax is only a source of revenue. However, revenue is the product of taxation. As we have said earlier in our example, let's say you are taxed 6% capital gains tax. The 6% CGT is the imposition of tax. But once the 6% CGT is already collected, we call it as revenue. Again, tax is the amount imposed, while revenue is the amount collected. Next, tax versus license. So tax generally is pursuant to the inherent power of the state to tax, so the power of taxation, while license is based on the inherent power of the state regarding police power. So tax, again, based on the power of taxation, that's the very first distinction, while license is based on the police power. Now, let's go on the different uh, distinctions. First, as to purpose. One purpose of your tax is for revenue, while for license, it is purely for regulation. Please take note that although for purpose, we limit it for revenue, you already know that there are different purposes of taxation. But the main purpose, this talks about the main purpose. The main purpose is for revenue. For license, it is for regulation. Again, you can argue that both can be for regulation, right? Because again, taxation can be used as an implement of police power. However, we're talking about the main purpose. Here for tax, it is purely for revenue, license for regulation. Now, as to the limit, for tax, we said it is unlimited as to the amount. Do you still remember this one? The tax is unlimited as to amount. That is part of characteristics of your taxation. However, for license, since it is purely for regulation, it is limited as to the amount. Whatever is the amount of license fee that can be imposed, that is only the amount due. Now, as to the time of payment, for a tax, it is paid after the start of business. In short, there must first be uh, a business, or there must first be an operation before it could be subject to tax. However, for license, it is paid before you commence the business. We're talking about license fee. So if ever there's a license fee, before you can start the business, there must first be a payment of the license fee. But for the business tax, you will only be subject to business and income tax after you commence. Now, as to the subject or object of imposition, tax, you have unlimited or you have a comprehensive subject or object. You have already learned that it is comprehensive. So whenever we say it is comprehensive, it can subject person, properties, or privileges. However, for license, generally, the object matter only lies as to the commencement of your business or profession. Now, as to the non-compliance, for taxation, if ever you do not comply, it does not necessarily make the act, business, or profession illegal, but you will only be subject for non-payment of taxes, so civil generally, because again, taxes is civil in nature. In short, you will only be subject to penalties, surcharges. However, for license, your business will become illegal. And if the business is illegal, it could be, or you will be subject to criminal penalties. You can be subject to criminal penalties because it is considered illegal. Next, as to revocability. For tax, it has permanence of character. But for license, it could be revocable. So when we say revocable, since it is only a permit, once you don't follow your permit, then your business permit or license could be revoked. But for a tax, it is normally permanent once it is imposed on a particular person, property, or privilege. Now, as to scope. For a tax, the power to tax includes the power to license. Well, for license, Power to license does not include the power to tax. Why? It is only a police power. But for a scope of tax, you already know this one. Again, I kept on emphasizing it. The taxation can be used as an implement of police powers. In this case, it was used as an implement of police power. Now for tax, when is it imposed again? It is imposed after the start of business. After the start of business. That's why it is placed here post activity. Okay, again here. It is after the start of business. That's why it is post activity. Here, before the commencement of the business. That's why it's called as pre-activity. Pre-activity. As to the basis of imposition, so your taxation for business or your income tax is based on the current data, while for license, it is based on the preceding year. So normally, if you will pay now for your mayor's permit or your license, normally the amount you will pay is based on the preceding year or quarter. But if that is a new business, it is based on your capitalization. So those are the differences between taxes and licenses. So here we laid down all of the differences and distinctions so that if in case it will come out, you can easily identify tax versus license. Next, we have tax versus toll. So for tax versus toll, we have here tax is an enforced contribution, while toll normally is imposed again as a fee for the use of a road or a bridge. So for a tax, it is a payment for the enforced contribution by the state. For toll, it is a payment for the use of a particular road or bridge. So generally, for tax, we said even if there's no benefit received, but due to the symbiotic relationship, you can be subject to tax. However, for toll, there must first a direct relationship. What's the direct relationship? That you must use the road for you to be subject to toll. Here in tax, you can be subject to tax because it is an enforced contribution. While for toll, you must first use the bridge or the road for you to be subject of that particular toll. Now, as to the basis, for a tax, it is inherent power of the state. So being a sovereign state, then you have the power to tax. But for toll, it is more of an ownership. So here, so for sovereignty, again, it is inherent power of the state. Once we say we are a state, it means we have the power or the sovereignty, therefore we have the power to tax. But for toll, there must first be an ownership of the property so that you can impose a road or that particular bridge a fee. Now, as to purpose, the purpose of your tax again is to support the government. However, for toll, it is the compensation for the use of that road or bridge. Here, support for the government. Here, compensation because you use again that road or bridge. As to authority, generally tax is imposed by the government, while for toll, it can be imposed by the government or by private individuals. So you all know under your advanced financial accounting and reporting under public-private partnerships or PPP, or service concession arrangements, generally, it is first used by your private individuals to earn or collect the usage of that road or bridge as a compensation of that public-private partnership or the service concession arrangement. Thereafter, a period of, let's say, 50 years, it will now be transferred to the government. So early on the use of that road or bridge, let's say NLEX, SLEX, SCTEX, whatever expressway that is, it is first collected by the private individual, but after a lapse of some time, normally 50 years, it will now be transferred to the government. So generally, who imposes it? First by the private individuals while they are still under the PPP or service concession arrangement. But upon the lapse of the PPP or the service concession arrangement, then the ownership will now be transferred by the government. Therefore, it is the government who now demands for the compensation of the use of road or bridge. Next, as to the amount, again, as to tax, it is unlimited. As to tax, it is unlimited. However, for toll, it is again limited depending on the amount that will be imposed as a compensation. So toll is limited. So that is tax and toll. Next, we have tax and debt. So what's the difference of tax and debt? So for tax, it is normally based from law. So without a law, again, it is legislative in character. Without a law, there cannot be a tax. However, for a debt, it is based on a contract or a judgment. So if there is no obligation or no contract, there can be no debt. Or if there is no judgment against a debtor, then there can be no debt. But tax, the basis of obligation is law. For that, the basis of obligation is contract or normally the judgment. Next, what is the effect of non-compliance? Under tax, you may be imprisoned for non-payment of the tax, except for poll tax. But for that, there can be no imprisonment. Again, because of the constitutional limitation, no person can be imprisoned for non-payment of poll tax and debt. So if you do not pay debt, then no imprisonment. Poll tax, no imprisonment. Other taxes, you can be imprisoned. Next, is it assignable? So when can we say it is assignable? When we say unsignable, transferable. Again, taxes cannot be assigned or transferred. We already discussed the different doctrines regarding that. So since it is not transferred or it cannot be transferred, then your answer here regarding assignable is no. However, for that, again, one of the modes of extinguishment of your obligation for contract is your assignment. So if ever you assign it, then it means that the other party is already the person liable over the debt or has the right to collect that debt. So if ever, again, tax cannot be assigned, while debt can be assigned. As to the mode of settlement, we said that tax must be paid or settled in money, except for cases wherein we could levy or we could distrain. However, for debt, it could be paid for any type of consideration. It could be paid through service, through property, or through money. But the main consideration for tax, money only as a rule. Well, for that, it could be any other consideration. As the subject of set off, again, we cannot set off for tax. It is not subject to set off. Well, for that, it could be subject of set off. What is set off again? You are mutually creditors and debtors of each other. So for example, A is liable to the government for tax. Okay, liable. However, government also needs to refund A. So A and government are debtors and creditors of each other. We call this one your compensation. Can we compensate it? Again, we cannot set it off, but you can withhold it or you can use it as a tax credit. However, for that, it can be subject to set off. So for example, A is liable to B and B is also liable to A. A is liable for 100K, while A has 100K receivable to B and B has 200K receivable to A. You can set off the 100 so that B has only a receivable of 100K. So that can be subject to compensation or set off, while for tax, it cannot be subject to compensation or set off. Next, as to interest. So tax does not earn interest except when there is delinquency. Okay. So actually, it's not only delinquency, it could also be deficiency. So, sir, what's the difference of deficiency and delinquency? So when we say deficiency, it means that the amount you paid for your tax due is not enough. Let's say, for example, deficiency. Your tax due is 100,000. However, you only paid 50K. 100K, you paid 50K, you are considered deficient. So since it is deficient, it could be subject to interest. How about delinquency? When we say delinquency, that is the non-payment of tax when it falls due. So for example, it is due on April 15, but you only paid after April 15. So let's say August 10. So due April 15, you paid August 10. We call that delinquency. Non-payment asset falls due. Deficiency, the amount of your tax payment is not commensurate to your tax due. So again, our tax due is 100K, but you only paid 50K. You're liable for 50,000. We call that deficiency. You can be subject to interest. While for delinquency, non-payment upon the tax when it falls due. So our tax interest is 12%. While for that, it is based on a stipulated or your stipulation or when you are considered in default. So when we say stipulation, whatever is stipulated under the contract, unless there is a considered usurious interest. When we say usurious interest, the interest is too high. But general rule, as long as it is stipulated under the contract and the contract stipulates that you are liable for interest amounting to 50%, let's say, then if the parties agree, then that's okay. But you can argue that it is usurious, but it's up to the court. But once there's a stipulation, you follow the stipulation. If no stipulation, you follow the rule or the legal rule on the imposition of interest. So the interest here is 6%. That is our legal interest. If there's no stipulation or the stipulation is considered invalid, then you use now the legal interest. Again, if there's stipulation, follow stipulation. If no stipulation, then you can use the legal interest. If the stipulation is invalid, legal interest. Stipulation, if invalid or no stipulation, then legal interest. Who imposes the tax? Again, it is the state. Also, the local government can impose tax that it is imposed by the private individuals or the contracting parties. As to prescription, the prescriptive period is provided under the National Internal Revenue Code. It could be 3 years or 10 years, or for collections, it could be up to 5 years, etc. Well, for that, it is provided based on the prescription under the Civil Code. So when we say prescription again, that is the period of time wherein you cannot already impose the particular obligation. Therefore, the government cannot already collect taxes because of that time-barred prescription. For that, once it is time-barred, let's say after a lapse of time, then you cannot collect already the debt. So those are the distinctions between a tax and a debt. Next, we look into the distinction between tax and a tariff. For a tax, it is enforced proportional contribution. Alam naman na ninyo yan, paulit-ulit na yan. While for tariff, these are books of rates for the duties for goods imported or exported. So if we are talking about importation or exportation, we are referring to tariff. But for proportional contribution to persons, properties, privileges, excise, we call that tax. Next, we have tax versus special assessment. So for tax versus special assessment, first as to the definition, again, it is an enforced proportional contribution. While for special assessment, this is an enforced proportional contribution from the owners of lands benefited by public improvements. So normally you are assessed a certain percentage if in case you benefited out of the public improvement. The most common example here is you have here a house, let's say here's your house or your home. And then before, sobrang layo nyo sa road right of way. So ayan yung bahay nyo, sobrang layo niya sa road right of way. Dito na lang ako mag-drawing. Andyan yung bahay nyo, andito yung daan. Nasa pinakalikod-likod siya. Now, ang ginawa ng gobyerno, naglagay siya ng road na sobrang lapit dun sa property nyo na. So, this is the new road placed by the government. So, nag-connecta siya halimbawa. Now, because of the new road, what will happen to the value of your property? The value of your property will now increase. Since the value of your property will increase, you can be subject to a special assessment. So again, that is the contribution from owners of lands due to public improvement. What is the public improvement here? The road. And what is the you are subject to a tax known as special assessment because you benefited out of that public improvement. So itong owner of the land na may bahay, magbabayad ng tinatawag nating special assessments. Now, let's proceed to the subject of the imposition. So for a tax, you can again impose any object of taxation because again we said it is comprehensive in nature. While for special assessment, you can only impose it to lands. You can only impose it to lands. Next, as to the effect on the person liable or the owning the subject matter. So for tax, it is a personal liability. However, for special assessment, it is not considered a personal liability. Why? Because the person or because what is taxed here is the land. Therefore, whoever has the liability is the land. So land answers for the liability. While for tax, it is a personal liability. If you still remember also in your financial accounting and reporting, one of the direct costs of your land is a special assessment. If the land is specially assessed, then you increase the cost. So if ever that can be made as a reasoning also, that's why that the item liable over this special assessment tax is the land. So no personal liability, it is the land subject to tax. As to the basis of imposition, so it is due to necessity, but for a special assessment, what is the basis of taxation? Benefits received theory. So for tax, it is the necessity theory. For special assessment, it is the benefits received theory. Now, for the coverage of application for tax, it is general in application, while for special assessment, it is based on whether there was an improvement which benefits your land. So if there's a beneficial improvement and there's an increase on the value of your land, we call it a special assessment. So those are the distinctions between tax and special assessment. Now let's go to your tax versus penalty. Tax versus penalty for our last distinction. Tax is again an enforced proportionate contribution, while penalty is imposed as a punishment for the violation. Please do not interchange license and penalty. License, again, is imposed for the commencement of a particular business. Penalty is imposed as a punishment for any violation of the law. So if there's a violation of the law, let's say a while back in our license, if ever you operated without a license, we call that imposition as penalty. Before you operated, we call that license. If there is an income of that business and then you are now subject to tax, what do we call that particular imposition? We call that your tax. As to purpose, the purpose of your tax is to raise revenue, while for penalty, that is to regulate conduct through the punishment or suppression of injurious act. That is your penalty. The punishment or the suppression is known as the penalty. The authority normally who exercise tax is the government, while for penalty, it can be imposed by the government or by private individuals. As to the source, tax is again a law, while for a penalty, it could be imposed by the law or the contract. Okay. You know the penalty in a contract. You call this one as contravention of the tenor of the obligation. So if there's a contravention of the tenor of the obligation, we call that the penalties under the contract. That's why also penalty can be imposed by private individuals. Don't only talk about or think about penalty as something that is imposed by the government. It could also be imposed by private individuals. Therefore, if there's a contravention of the tenor of the contract or the obligation, then the private contracting parties can also impose penalties injurious to the other party. As to the mode of settlement, again, tax is settled by money. However, for penalty, it could be settled by any type of consideration, such as you can pay it through settlement by paying property or by delivering your property, also known as the Sean and Pago. Also, you can pay it through money. Okay, so that's how you settle a penalty. But for tax, it's generally payable in money. Therefore, what are the common items that you need to determine when you try to differentiate tax with other items? First, always remember that it is enforced contribution. It is an enforced proportional contribution. Next, it is again generally payable in money. Third, it is legislative in character. Next, it is normally imposed by the government or the state. Also, you can place your comprehensive, unlimited, and supreme. Okay? So you can place the different characteristics of taxes when you try to consider knowing the distinction with other items or impositions. So that's it for taxes and other impositions.